Nvidia was down over 3% just on Friday, and from then on we have had some negative news. We have Wall Street saying how Nvidia is losing more momentum as the share price does start to come down, as the AI rally starts to slow down. We have talk of how Microsoft is back as the most valuable firm after Nvidia was only sitting up there for a few days. Yet on the flip side, we have some very positive news about this company just from Taiwan Semiconductor's earnings, where they did talk about beating both revenue and profit. Now, why this is very bullish for Nvidia: they are essentially the largest producers of these chips, of these advanced processors, which Nvidia and Apple are their clients. So if their top lines are increasing, more demand is coming, then this is a very bullish sign for Nvidia, with their top line as well exploding. We can also see that Nvidia have released their projections over the next few years of their increasing products that they are bringing out. We have Blackwell Ultra GPU, which is coming out in 2025. They're already looking at 2026 as well. They will launch the Rubin GPU, and in fact 2027. So they are looking far ahead. The demand is there for this company and for their products, which is why we see this company exploding. And as we have mentioned before, AI is here to stay. In fact, Bloomberg see this as not only a 1.3 trillion market by 2032, but they believe every single year it will be going up 42% for the foreseeable future. Again, another very bullish signal. Now, what does this mean for Nvidia? Is Nvidia now a massive company that is undervalued after the drop that we should consider to buy for massive gains into the future? Well, we can see Wall Street here considering this a very strong buy, although we do see 2 hold ratings. Now, it does have a yield, although very minimal, so we won't discuss it too much on the episode, and it does trade for a forward P of around 46.72. Now, in today's episode, we are going to do a full deep dive of this company. We're going to take a look at a lot of information. We're going to remind you of some of their very strong metrics, like their free cash flows, their sales growth, their ROIC. We also want to talk about the CEO, who has been selling a number of shares. In fact, just over the last 12 months, we see 433 million worth of insider selling. We'll also discuss what institutions have been doing in the more recent quarters as well, whether they've been buying or selling, and we will look at their latest investor presentation, some very key slides that if this is the first time you're looking, you really want to pay attention and understand where this company is moving. And as always, we will run it through our own valuation model. We're going to get to the intrinsic value, our acceptable buy price. We'll discuss what Wall Street themselves see as the target over the next 12 months. And we'll also run you through where our numbers are coming from, the valuation model in detail, 3 different growth rates, low, medium and high, so you can also understand and estimate yourself what price you believe Nvidia should be trading at and whether or not there is a lot of upside for future gain. But let's just remind ourselves, this is a company that is trading at a forward PE of 46.72, which we will discuss later on in the episode, whether or not it is justified to be trading, and if they do hit their estimates over the next few years, this will come down significantly lower. And it has skyrocketed not just 194% over the last 12 months, but over the last 10 years, if you have been a shareholder, you would be up more than 27,000%. Now, in terms of insiders and what they've been doing, well, 4.23% ownership. As we mentioned, significant amount of sales by 8 different insiders just over the last year, with the greatest bulk of that, 253 million, coming in Q2. Now, in terms of who these insiders are, notably we do see the CEO himself, Jen Huang, sell 120,000 shares, although this is part of essentially his filing where he will be selling around 600,000 shares worth. And as we can see, $15.5 million. That was around $129. Whether or not you do believe this to be a bearish signal, or you believe that management do sell for other reasons, personal or financial, completely up to you. The data is there. We do want to be transparent. What we would say, typically a bullish signal is when insiders buy, because realistically they only buy because the share price will go up. When they sell, no one really knows, so we wouldn't personally include it in our own investment thesis. In terms of the institutions, well, 65% institutional ownership, 8.6 billion worth of sales by these institutions over the last 12 months. We see a lot more buying over the same time period. However, the one thing that we would want to point out in today's episode is that in the more recent quarter, Q1, institutions have been selling more than double than they have been buying, 5.1 billion versus 2.5 buys. So just bear that in mind. But what is also very imperative to understand today is to always do your own due diligence. don't copy what insiders do if they buy or sell. Don't as well copy what the institutions do, whether they also buy and sell. Now, what we want to point out with this company is their top line revenue growth. Typically with companies, we expect 3 to 7%. We just want to highlight here, they have grown rapidly from around 5 billion 10 years ago to 61 billion in January 2024. And purely on a trailing 12-month basis, 80 billion, we can see that this company is going to continue to grow further out into 2025 and beyond. And just on a graphical basis, you can see that just over the last few years, this has really skyrocketed, and they're already thinking about 25, 26 in terms of what products they are bringing. They have Blackwell as well as Rubin that we did see at the beginning of the episode. Bottom line as well, just on a graphical basis, you can see the explosion in just the last few years. It has gone from around 631 million that they did report in 2015, and as we can see, 30 billion in 2024. And look at that on a trailing 12-month basis, 43 billion. So they are expecting that to continue, not just into next year, but as we will see later on in the episode, this growth does look to be sustainable over the long term. Now, how does the health of the company look? Because that is also very important. Total cash versus total debt. 4.6 billion in 2015, 31 billion in their latest quarterly report. So they do hold not just a significant amount of cash, 31.4 billion, but as we can see over the longer term, they are holding more and more quarter on quarter, year on year. And when we do compare that, because it is important, in isolation it doesn't mean anything. That's why we look at it numerically and directionally to their total debt. While that has increased from 1.4 billion to 11.2, their cash is far, far superior, which means it wouldn't even take them one day to pay off all of their debt net of cash on hand. And as we can clearly see here, a very similar trend to the cash. It has been increasing their debt over the longer term, but no worries that we can see based on that high level review. Now, what is very interesting for those that haven't seen this essentially shows us how they've performed in the last few quarters, which as we can clearly see here, 4 for 4, they beat in the last 4 quarters what essentially the market had anticipated. And on top of that, into the next quarter, which they will be reporting over the next few months, triple-digit growth on the EPS, 135% year on year. Over the next 3 as well, strong double-digit, which if they do hit their January 2026 EPS target of 3.57, then the forward P is expected to sit around 35.5, significantly lower than what we do see right now. Whether or not this does give you enough confidence that they have a 100% track record, again, completely up to you. What this does show us though, past record looking very good. Forwards looking, if they are able to hit that, that is some very strong growth on a year-on-year as well as a quarter-on-quarter basis. The next thing that we want to do is look at a very few underlying metrics and their gradings. First one that we can see here is the valuation grade, which for Nvidia they get an F, so let's just talk about that very briefly. In terms of the P on a non-GAAP, 46.72, what this is showing us that with the sector median at 24, that they are trading right now at a premium of 98%. Whether or not you do believe that to be justified and warranted, again, completely up to you, but we're just going to talk through whether or not that is by also looking at other metrics in comparison to the sector, like the growth and profitability. Right now, though, you can see essentially in any valuation metric, they are trading at a far, far premium rate than others in this same industry. So let's move on then, and we can see why now. Firstly, on the growth, they do get an A+. Year-on-year revenue growth, 208%. The sector as a whole, low single digit at 3%. So you can already start to understand why they are trading so high. Revenue growth 80%, sector median 6.6. In terms of the next 3 to 5 years, their earnings per share is anticipated to grow 32%. We can see others in the sector 14.18 on a median perspective, and we can see just pretty much across all of these growth metrics, they are trading A+, which does show us much better growth forward-looking as well as historical than the sector median. This does bring us on to the profitability with an A+, so we can already see 75% on a gross margin basis, sector median just under 50%, bottom line 53%, sector median low single digit, and one of the greatest things we can see here, their cash from operations 40.5 billion, as we can see the sector median 92 million. So a lot better than the sector in terms of the growth and profitability. And as a quick recap, we get a strong buy from Wall Street, a double hold from the other 2 analysts, whilst we see an F on the valuation, an A+ on both growth and profitability. Now, when we take a look at how they've performed against others in the industry to see whether there's a trend, if this is for all companies, they have been exploding in terms of the share price. We have Taiwan Semiconductors that we just discussed earlier, Broadcom, Advanced Micro Devices, Qualcomm, and Texas Instruments Corporated. What we can see just over the last year, Nvidia is up 194%. The only one that does come close, Broadcom, 98%, and as a reminder, they will be doing a 10-for-1 split next month. Over the last 10 years, again, that trend does show again. Nvidia in a world of its own, up 28,835%, and we can see none come even close, even AMD, which is also up incredibly, doesn't come anywhere near that of Nvidia. Now, very briefly, this is just something to question yourselves, maybe not an Nvidia question, but one for others in your portfolio. There's no point in investing in companies if you don't expect them to outperform the S&P. As we can see, Nvidia has outperformed the S&P not just over the last year, but also over the last 5 as well as the last 10 years. But just something to ask yourself moving forwards, whether or not you do see this company starting to slow down, or if you believe it will continue to outpace that S&P. Now let's jump into some of the metrics, but before we do, we want to highlight some very key points from their latest investor presentation. First one is essentially the progression of those CPUs, their processors. Now they are already looking forwards ahead of Blackwell, as we just saw earlier on the episode. 2025 Blackwell Ultra, 2026 Rubin, and I do believe 2027 the possibility then of having that Rubin Ultra as well. So they are already thinking not just into this year and next, but also a few years ahead, and we can already see the progression of these just over the last few years. In terms of moving forwards, where can they expand, or where can they bring a lot more revenue generated into this business? Well, they do look at 4 different areas. We have essentially the cloud service, consumer internet, the enterprise, the autonomous vehicles and robotics, which we did talk about on an earlier episode, where Cathie Wood is very bullish on Tesla and how this will essentially benefit the top line of Nvidia as well. And we can see industrial digitalization. So with Nvidia, a lot of what they're doing in terms of their management, they're thinking ahead, not just how essentially this business is going to be able to progress over the next year or two, but they're looking at the next 10 years and beyond, looking to see how they can essentially, for each element of this, increase their revenue and top line. Not only that, what people love about Apple is the fact they have this massive ecosystem where people will leave and essentially lose Apple a lot of revenue. What we can see, Nvidia are doing the exact same thing. The developers just over the last few years have more than doubled. We can also see these startups within their ecosystem more than doubled, and essentially the applications as well more than doubled just over the last few years. So this is one way where they can keep accelerating their top line as well by expanding their ecosystem, as we can clearly see they have done over the last few years. On top of that, they are talking about a huge ROI, so return on investment, not just in the areas that you may think of, but we have quite a lot of different areas. We have customer service, we have drug discovery, we even have agricultural food, and they are talking about different ways where AI can continue to expand into a new investment cycle, and we can just see here a few different income streams where they do believe in the future, if not already, they can start to tap into. Now, we've already looked at this, but again, just as a reminder, this is essentially showing us that how the classical computers were in terms of the GPUs, 960 CPU only servers, now with their accelerated computing, 2 GPU servers, and we can see what this benefits to their clients: 25 times lower cost, as well as 84 times better energy efficiency. There is also the discussion of what benefits or other benefits this has for those consumers, for the clients of Nvidia, and we can see they're essentially talking about here that $1 upfront investment in Nvidia in their products will essentially translate to around $5 in revenue over 4 years. So not only are they producing this product that a lot of people want, but they are also explaining how it is going to give them a lot of benefit into the future, a lot more productivity as well. In terms of the numbers, now this is what I find phenomenal about this company. If you look FY20 to FY23, there's been some very nice movement, but the explosion just happened in the more recent year, more than doubled their top line in FY23 to FY24, and if we do extrapolate their year-to-date FY25, you're essentially saying that they will report in FY25 around 100 billion on their top line, which is absolutely phenomenal, nearly double what we just saw in the more recent annual accounts. On top of that, what I always love to see, one of the things that you really must look out for in companies you invest in, not just increasing their revenue, but also their margins. This is essentially their operating margin, 34% going to 69% in the year-to-date FY25. So we can already see again, just in the more recent quarter against the full year of 24, they are still increasing their margins as well as their revenue. And here we're just highlighting that the large driver of this company's explosive revenue has come from data centers. As we're about to see, the CAGR on that is very, very high. Not just operating margin where they're increasing, but we can also see they're increasing their gross margin, 63% in FY20, 79% year-to-date FY25 as well. This will essentially mean their bottom line will get even larger, and as we saw on the trailing 12-month of FY25, this also looks to be the case for Nvidia. Finally, well, free cash flow, we do love to see this is one of the important metrics we want to see. We want to see consistent increases over the longer term. Now, it has been a little bit inconsistent from FY20 to FY23, but we see that explosion into FY24. And if we do extrapolate the year-to-date FY25, what we see here, 60 billion in free cash flows, more than double just FY24. On top of that, different ways they return excess cash to investors after those share buybacks. We can see they've used around 9.5 billion of repurchases just over the last full year, and they have more than that to remain for the end of quarter one FY25. So again, do expect them to do a lot of share buybacks over the next year. Now, whilst this latest investor presentation does talk about the plan to maintain their dividend, good news for those that do like that dividend, they have increased it 150%. Now, just something that we just mentioned earlier, as we can see their data revenue, which has exploded, has increased just over the last 5 years, 75% CAGR, which effectively means compounded annual growth rate year on year. So phenomenal to see. This is one of their leaders in why their top line revenue does continue to grow. And the final slide from this investor presentation is looking more towards the future, how they will be able to increase not just their numbers, but also their profitability. They have these 4 different areas that we did discuss earlier. And in fact, they do believe that the autonomous machines is a 300 billion market, as well as data centers. So a lot of areas where they can continue to grow for those that do consistently talk about this company as being in a massive AI bubble. Now, just want to make you aware, we have released our latest free weekly newsletter. If you want access to this or any other articles, all completely free, do click on that pinned comment below. Instant access to read straight away. For example, if you want to see how to find undervalued stock or the high quality screeners that we use, you can click on this and read straight away. Or if you want to see 12 undervalued high quality companies, again, instant access is provided. Now, before we jump to the valuation, just a few metrics to highlight here. Free cash flow that we did discuss earlier, whilst it has been growing consistently over the longer term, we do see the massive explosion from 23 to 24, and we can see just into FY25, they're expecting more than double from 109 to 259. That is a 100% increase. Do bear that in mind. It is quite important when we do come into the valuation part of this analysis. In terms of sales growth, well, we can already see well above that 3 to 7% minimum just over the last full year, 126%. And again, just another format to what we saw numerically. And whilst over the longer term, they have diluted your position due to issuing shares more than they've bought shares, you wouldn't care as an investor due to that share price return. And as we discussed from 2022 onwards, they have done some share buybacks, and that is something management are looking to continue. ROIC, well, this is one of our favorite metrics, giving us faith that management are able to effectively allocate their capital if it does sit at 10% or more. In fact, 12% or higher for industry-specific semiconductors. Just in 2024 alone, 61%. Trailing 12-month basis, 78%, so looking very solid as well. And in terms of their margins, what we always want to see that we have seen from their presentation are operating efficiency. It has been increasing over the longer term. Look at that increase, 16% to 54%. And the same to be said for this free cash flow machine of the company, 17% in 2015, 45% in 2024. Finally now, the net debt to EBITDA, this is the earnings before the interest, tax, depreciation, amortization. The numbers below reflect the number of years it would take the company to pay off all of their debt net of cash on hand. Below 1.5, and this signals it wouldn't even take them one day over the last 10 years or one day into the next 12 months to pay off all of that debt net of cash on hand, signaling us to they have a very strong balance sheet, and that dividend, whilst it is very small, is incredibly safe. So let's jump into the valuation model. As always, if you do enjoy the content, values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. For the discounted cash flow model, we have the free cash flow year on year, average growth rate 94%. Their growth rate moving forwards, we have gone for a 25% estimate just on the low target. Now, do bear in mind two things where we are making a lot more conservative. The first thing is that we just saw into the next year, they're anticipating more than 100% increase to the free cash flow. And whilst if we did extrapolate their free cash flow, as we said earlier, it would be significantly higher than the 2025 number we have inputted now. So this is extremely conservative. So on a 25%, if you do believe this, with the discount rate, we get the present value of future free cash flows and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by those shares outstanding, and we have an overvaluation signal, meaning that the share price are valued at $101 if you do believe growth rate of 25% into the future. Also, bear in mind that article that we did discuss at the beginning did say compounded annual growth rate around 42%. So that is implied downside of 20%. For those that believe that is way too conservative, at 30%, we do essentially get an intrinsic value of $140. That does give us implied upside of 10%. And for those that do believe that is still way too low, at 35%, we can see $192, therefore telling us that there is implied upside of 52%. Now, these numbers are all subjective. It will really be down to what you envisage for this company over the longer term. And as always, you can click on the pinned comment below, grab a copy of this model yourself so you can run your own numbers through. But as always, 25%, $101, 30, $140, 35%, $192. And what we're going to do is take the medium rate through to the next slide, 30%, giving us an intrinsic value of $140. So as today it is just the DCF model that will take part as our intrinsic value, and with the current price around $127, we always start off with a margin of safety. Now that margin of safety will be 10% to start off with, and we use that and execute on that if it meets our 3 golden criteria: a wide moat, strong financial metrics, and good forward-looking data. If you believe that for Nvidia now, then it does look to be a buy around $126, pretty much around the current trading price. So remember, if you believe Nvidia over the longer term will be growing around 30% of the free cash flows, then right now you are looking around a 10% margin of safety. As always, if you do use different numbers, then this will change, so you can grab a copy and play around with that. But for those that are looking for a much larger MOS, 15% would indicate a buy at 119, 20% MOS would indicate a buy at 112. So in today's episode though, we just see about a 10% margin of safety based on those numbers. In terms of Wall Street and what they expect, well, they have a price target of $131. They see upside of 4% over the next 12 months. And as always, let us know your thoughts in the comments below. Is this one you are looking to add? Maybe it's on your watch list, seeing if it dips further, or for whatever reason, maybe you see the valuation as stretched and it isn't one you're getting into right now. If you've enjoyed today's episode, value was provided, smash that like button, hit that subscribe and bell button, and as always, we'll see you all on the next one.